Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the week ending May 15th, 2015, halfway through May, getting into the early summer months. What I've got on the screen here is the cash index, the S&P 500, SPX. You can see here, I think it's interesting. We need to take a step back for just a second and see kind of where we've been, where we could be going, and more important, where we are right now. If you look at this chart, again, it's a monthly chart, but I put on here Fibonacci extensions off prior pivots, and these are key pivots. And since we're using the monthly chart, I'm going back to the pivot high that we made in the latter part of 2007, and the pivot low obviously made March 6, 2009. And I've run these extensions off of these pivots, and you can see here, these are the key extensions we need to look at. And the one that I really want to focus on is this purple line right here, which is the 61.8% extension off of that prior pivot low based on the pivot high based on the distance between these two pivots right here. Again, we're looking at the monthly chart, so we're going back 8 years or so. But this is really crucial to kind of see where we're sitting right now. Now, on this monthly chart, you can see the dramatic vector of this channel here for the top line of the channel, the bottom line of the channel. You can see just how steep this is. Very dramatic. And we've really been in it going back to, as I said, March 2009. But we had a pretty good little pullback here and a pullback here. But, you know, really since that pullback in the middle to latter part of 2011, we really have not had much of a pullback at all. You could see one brief dip below. That was last November of 2014. But outside of that, we've stayed pretty much confined in this channel. And a lot of it is because of the stimulus that we've been doing here in the U.S., and a number of other factors. I'll go into a couple of them, but you can see where we're sitting. Now, these colored lines right here, I've only got 3 on the chart that I put. This is the high for 2015 at 21.2592. That's the intraday high, and the intraday low for 2015 of 1980. So you can see, first off, the distance between the high and the low for 2015 is a fairly tight band. You're looking at, you know, and looking at this, you're only looking at about 45 points or so. It's really amazing that we've been in a fairly tight band for almost half the year. We're halfway through May, coming up on, we've just had option expiration, the monthly options this past Friday, and now we're coming into a new series in June. But you can see the very tight band that we've been in. And I do believe we're going to break out of this band. And I was telling our members that we would probably make a new high, but then run into some serious resistance. So that just shows you the tightness of the band. And then this blue line, of course, is the opening price of the year for the SPX, which is 2058.20. The SPX, or the E-minis for the S&P 500, opened at 2055. So and as you can also see, let's just zoom in a little bit so that we can get a better, clearer picture of this. So you can see this monthly chart and where we're sitting right now. Now, what I'm going to do is I'm going to take this little band off here, and then let's go in and let's take it down to a weekly chart for a minute. You can see this tight channel that we've been honoring, and again, each bar now instead of a month is 1 week. And you can see where we're sitting right now. We're not at the highs of 2014, but we're pretty darn close. You can see this purple line is the 1.618 or the 61.8% extension off prior pivot highs made back in 2007, which is a key Fibonacci resistance number. You can also see, if I just kind of condense the chart a little bit, you can see how the MACD has continually been getting weaker and weaker as we've been going higher and higher. Now, something's going to have to give here pretty soon. I believe the risk to the upside, I've been telling our members, is about a 2% move up. So that would put this, at around 2145, 2150 area roughly. And then probably greater than let's say between a 5 and a 10% move to the downside. So the risk obviously of a move is greater to the downside than to the upside as far as the distance traversed. But we're sitting here at this area here, and I just don't see a lot of impetus for really driving this much higher. And we had weaker volume, by the way, on this move up as well. I'll show you that in a minute in the futures market. But you can see where we're sitting here. Now, again, if I take it into a daily chart, and let's just zoom in even tighter, you can see that purple line, which is the 1.618 Fibonacci extension off to 2007 highs. You can see where we are right here. The pivot low made in 2015 of 1980, the pivot high at 2125.92, and we almost got there on Friday, and then we kind of stopped. But even if we take out the high, which it wouldn't surprise me if we did, I mean, we've just got major league bearish divergence setting up here, and I honor bearish divergences as one of the best charting indicators you can get. It doesn't tell you how far down it will fall, and it doesn't tell you when it will start, but it does tell you that the markets are getting weaker as you go higher with these divergences. You've got to honor them. So this is where we're looking right now on this chart for the S&P 500 cash index. Now, if we look at the S&P 500 futures, or called the E-minis, you'll see I've got a lot more lines on my chart. But you can see here for the E-minis, we actually did make a new high on Friday. We went up to 2122.75. But again, making these highs, and we're barely above the zero line in the MACD. We still got that kind of set up there. In fact, we made a new high on Friday before the markets even opened, and then we spent the rest of the day just kind of pulling back a little bit, but kind of a non-event day, right? But that's where we're sitting right now, and I got a little bit of a resistance zone where we are right now. We're definitely above the 50 EMA. You can see that red line right there, which is the 50 EMA, and all of these were basically intraday moves below the 50 EMA, except for just one bar below the 50 EMA, but we quickly made it back up. So going all the way back to basically the end of March, and we're into May now, we haven't been below the 50 EMA. Buyers have stepped in. But I do believe this may change. You can see I've got a lot of support and resistance zones on here for our members as we go through the various day in our chat room, and where the high and the S1 low, the R1 highs are for the day, and where the resistance areas are. The other thing I want to show you on the E-minis is if we come in here and we take a look at the volume, and if we take a look at the, you can see right here, volume is really anemic. Now on my volume chart, let me just, I'll kind of move it up here so you can see a little bit better. I'm blowing it up. But you can see here, I run, just like moving averages on the chart, I run EMAs on volume, and I run two of them. I run a 5 and a 20 EMA, and you can see the 5 EMA is below the 20 EMA. So near-term volume on this move here is very weak, right? We just we bounced off the 50 EMA, and we made all-time highs on Friday before the markets even opened. We pull back. But the 5 EMA of the moving average of volume over the past 5 days is lower than the 20. So we've had, and you can see here, just the movement in the volume. So it's really anemic. I really want to see volume kind of moving up like that, but we're getting just the opposite here. So we need to be careful. Now we are coming into over the next couple of weeks, we're going to be getting some key reports from the Feds. Everybody seems to be, wanting to see what the Feds are going to do with the interest rates. But this is where we are with the E-mini. So keep in mind we're above the 50. If we look at the let's take a look at the NASDAQ, and let's go back to the monthly chart. Now on the monthly chart with NASDAQ, we are very darn near close to the all-time highs of NASDAQ. Intraday highs was made, back in March 2000, when we hit the 51.32, and we're very close to hitting that now. You can see this very sharp run up here. You can see the red line, the blue lines, and where we're sitting right now with the NASDAQ composite. This would be all of NASDAQ. And we break it down to a weekly chart. You'll be able to see we're still, I think we're very, very close to taking out the all-time highs of 51.32.52. The blue line, of course, is where we open the year. And if we come into the daily chart on NASDAQ, you can see exactly where we are right here. Right there is the highs that were made on April 27th, but the all-time high is that green line right there at 51.32.52. Again, we're above the 50 EMA, and we got a positive glide path, but just like the SPX, we've got this bearish divergence, and even if we've got that final thrust, we don't have enough energy to clear up very high before, you know, we've got that possibility of a roll back down to the 50 EMA, or even to the bottom part of this channel on the NASDAQ composite. So I'm just not that comfortable with what I'm seeing right now, which is why I haven't been doing a lot of longs. I've been playing the market up because that's the direction it's given me, but I'm fairly well hedged. Most of 2015 for our members is we've been doing sideways trades, range bound trades, these kind of things. If we look at the Russell, this one is weaker. Now, the Russell was leading the way in March and February, and then March, and then it all of a sudden pulled back dramatically. We just cleared the 50 EMA on Thursday, and then into Friday it held. So the Russell is way away from the highs made for 2015. And you know, the opening price of the Russell futures provided support to us back on May 6th, and then we're just now recapturing the 50 EMA. So small cap and mid cap have been weak over the past 3 weeks. Large cap have done fairly well, as well as consumer staples. And that is a sign of more of a risk off environment than a risk on environment. So we're seeing some of that shift that is not indicative of a good solid bull market. Okay. And if we look at the Dow, if we look at the Dow index, and let's look at the Dow Jones. Let me find it here. Let's see, where'd you go? Here we go, right here. Here's the Dow. You can see as it comes up, let's step out to the monthly, and I've run the same thing on the Dow, the extensions, and we're not near the 618 extension off the prior pivots. You can see I've got that tight channel that really started back in 2011 and has moved up solid. You can see this trend line there off of the prior pivot highs for the Dow. But the Dow is not as strong or as robust off the prior pivot highs as the NASDAQ, which is almost at all-time highs from the 2000.com bubble, and the S&P. But you can see the red lines where, again, a very tight range. The high for the year, 18,244.38. The low for the year of 17,037.76. And then the opening price. So we're fairly tight. And if I come into the daily chart on this same index here, you can see where, again, we just actually, and I'll move this up to give us the classification, we're almost at the highs here, but not quite for the year for the Dow. All right. But again, same with all the other indexes. We've got that really ugly looking bearish divergence that would suggest we're going to show some weakness going into next week. The market does not seem to want to go up much higher. The economic news coming out is showing it's not very good news. It's not bad news, but it's not really enough to keep propelling us to all-time highs here. What's doing this, a good bit of this, is the just the stimulus and money coming all from Japan and from Europe and so forth. So that's kind of where we're sitting here. If we look at the bond market, we had a huge run up on Friday in bonds, and that was something that I had talked to our members about. We played this bond market straight down, made great money on this. It was a really good trade for us. And you can see here that I had anticipated a bounce. I told our members we're probably going to get a bounce in bonds. You can see the chart right here. This is a daily chart. In fact, I would not be surprised to see bonds come up and test this zone right here. So that would suggest a little bit more upside movement in the bond market. But right in this zone here, I'm going to be a seller rather than more of a buyer. We got that cross in the MACD, but we're well under the southern side of the zero line. So bonds, this is just a huge move that cannot be ignored, right? So we could get one of these down moves, counter trend move, and then another move back down. It puts us more towards the bottom down here. I do not believe bonds are going to go much lower than this, only because interest rates, a lot of this big interest rate move here, remember, when bonds go down, interest rates go up. A lot of this bond movement down is anticipation of the dollar or 25 basis point interest rate rise. So a lot of that's priced into the market. So when they do raise the interest rates by 25 basis points, I would not be surprised to see a little bit of a downshift, but then a counter trend move back up again, right? Because a lot of that interest rate rise has already been priced in. Where the market seems to be focused now is not so much that first 25 basis point rise, but when are the other rates going to start coming in? And right now the Feds have signaled that, hell, they're going to wait a year or so before they just start doing that. So you're still going to have, if you think about it, an interest rate of 25 basis points to the banks and the banking system and what's going on, which sets generally the 10-year yield, tends to set the mortgage rates for housing and real estate, but it's still extremely very low. And at that low rate, so you've got very cheap money. You've got almost no inflation, so the Feds don't have a need to raise interest rates. So after they get that 25 basis point rise out of the way, they're probably going to sit on their heels for a while. I think we could get another run up in the market, but then I think we're going to have a bigger implosion later on. Not right now, but later on. If we look at the 30-year interest rate, this is a chart of interest rates. You can see right here where interest rates started going up back in the end of January, and we had a little bit of a pullback here, but rates have been moving higher and higher. We're now, I anticipate interest rates to come back down. In fact, my chart is calling for, we'll split the difference of about 2.74 on the 30-year before it starts to gather wind and then start moving back up again like that, giving us an Elliott Wave 5 pattern. So that would give us the common 3-leg, 4-leg, and then 5-leg. So that is just one possibility. We do not have bearish divergence between that pivot high there and that pivot high there. In fact, it's actually like that. So any pullback here is gonna, the tendency will be for buyers to step in and drive interest rates higher, or rather said another way, sellers to step in and drive bonds lower, which would then drive interest rates higher. So that's kind of what I'm looking at right now. But we've done very well in trading these so far. Currency wise, the euro has just been on a tear recently. You can see the euro where, you know, it made its low back in the second week in April, and it's just been moving up strong. I think the upside of the euro is we're going to get pretty close to it. The dollar, which kind of moves opposite of the euro only because the euro counts for such a big part of the dollar index. You can see the dollar's come unglued. A lot of this was initially profit taking, but now we're getting into distribution. You can see the volume here moving up with the dollar as the dollar moves down. We're still lower than normal with the volume. You can see right here volume and right here volume. It's getting these spikes, you know, like that as the volume's been coming down. Okay, you can see this run up here. We had volume going up as well. Now we got increasing volume as it's coming down. So there's a lot of distribution going on in that dollar sell-off. Everybody was long the dollar and short the euro. So we're getting a bigger move than normal anyway, because it's just short covering or covering longs, depending on whether it was the euro or the dollar we're talking about. In the dollar case, basically, you're covering the longs, everybody's selling, which drives this thing a little bit lower. But I do believe the dollar is about ready to settle in somewhere here and possibly have one of these kind of patterns like that, and then start to move back up like that again. It may even give us a cup and handle where it comes down, and then boom, off we go again to the races. So, I think over the summer months, it's going to be kind of stuck in the doldrums right here. Everybody knows the interest rates are going up, so a lot of that was priced into the dollar right here, but now it's seeking a normalized balance, and that's kind of where we're sitting here. Now, our favorite currency trade of the past month, and I've been talking about it for a while with our members, was the British pound. If we look at the pound here, this thing is just taken off like a bullet. And we've been long the pound, really enjoying this run. The other thing that's nice about it, just like the dollar, you can see this a little bit of a profit-taking move right here, right? But you can see very low volume when it was down at that area there. The volume just fell off as it pulled back, and then bam, away it goes. You can see, bam, there goes the volume again. So that's solid buying right there. And we're long the futures, or FXB would be another way to play it. It came right down to our support point. I was quite frankly expecting this to stay down in this area longer, but I took the trade because the charts were telling me to take it. So that's what we did, because I wanted to go long the pound. Now, the pound is the kind of currency that does get pretty choppy when it moves up or down. But I like playing currencies because they tend to hold a trend for quite some time. So this is the way we're playing the pound right now. We're enjoying it. It's a nice trade for us. And you can see here from these pivots, from this pivot high to that pivot high there, we're not getting any divergences at all. It's a rocket ship up. So any pullback here like that, and then if we get a turn up higher, that would be another buy signal. Add to your longs. Or you can get stopped out, but then go back in once it does a turn again. I think the pound's going to go higher. Now, I think there is a limit to where the pound is going to go, because to some extent, whether they're part of the European Union or not, the biggest trading partner of Britain is the European Union, or the ECB. And as long as the ECB stays relatively weak, the pound is going to have some overhead resistance on it as well. So that's kind of where we're sitting here. So what's that overhead resistance? I would say near term it's going to run anywhere from about 158 to 160. You can see these natural price resistance points here. And then we can expect it to hang up here a little bit before it clears any more hurdles. That's kind of where we're sitting there on the pound. And if we look at the and silver is another one in the precious metals or in industrial metals. We've loved silver. You can see silver's moving up. Long term, our members know that I like silver, and this is one thing that we're playing to the upside. If we look at volume, again, it's telling us what we want to know, right? Again, I run a 520 EMA on this, but you can see as silver's been moving up, I've got an initial target here of around 18.5, right, on the chart. But look at the silver, look at that, the volume, it's just straight up. I mean, I can't draw it any, as rocket ship up like that. You know, the 5 crossed the 20 EMA and boom, away we go. All right, and you can see as silver was selling off, volume was creeping higher, right in that point right there. And then, but once silver started taking off, you can see these green lines here. Volume just came up big time, right? And then we settled in here. It didn't go anywhere on very low volume down here. And then, bam, it took off. And I've just been, our members know what I'm doing with silver. It's a good trade. We like it, and they know how to follow along with what I'm doing. By the way, if you're not a member of our group, I highly encourage you to come over after you check this video out. Just go to our website and check us out, see what other folks are saying. Come on in. We're getting a lot of people coming in internationally into our group, which is pretty cool. The other one is energy. Oil has been relatively strong. Members know the way I've been trading oil. I've been very profitable on oil this year, both to the upside and to the downside. You can see I've got a near-term target of oil right now around, call it 54.66, call it $55 a barrel roughly. I think some of this overhead is going to be met with a lot of firm resistance here. downward pressure. We've had a really good run up here, but it's going to get very tough. I think the upside target of oil before the end of the summer may even take us up to the 70. I don't see it going much north of that. I may be wrong, but I just don't see it going much north of that. I do see a little bit of weakness in it down in this area here, and then probably a final thrust up like that, giving us an Elliott wave 5, and then it's just going to peter out like that as we go into the fall time. That's what I see now. Now, if the charts change, again, we look at this every day, we get new information, a new bar, new information with all our indicators, and I look at them and I just say, is the game plan still on, or is it modified, or is it now going back into more of a no man's land? Right now, this is the game plan, a little bit of a pullback. So that's kind of how I'm looking at that. Natural gas, we're coming into the time here where I think natural gas is seeing a little bit of a nice strong run, but I think it's going to start to show some weakness here. So there are ways that we're playing nat gas as well. Gasoline, same thing, a little bit of weakness. It's had a pretty good little run, but a little bit of a weakness here in nat gas. We're getting the bearish divergence, so I'm seeing it hang up here as well. Now, ones that we like that I want to jump long on, not yet, is the corn market. You can see right here, corn, it's had this pullback here. I'm going to look at corn long. I'm looking at soybeans long. Not right now. We're in this downward channel, as you can see right here. I'd like to see it come a little bit lower. That means our entry price will be a little bit better, and we'll jump on that. So these are some of the ones that I like. Now, one other thing that gives me a little bit of a pause on the market, I didn't talk about it before, but I will right now, is the Dow Jones transports. Look at the transports. I mean, guys, this sucks. This is 2015. You can see the high for the year of 165. The opening price, the blue line, was almost near the high of the year, and we spent the rest of the year basically going in that direction. We're below the 50 EMA. We regained the 200 EMA on Friday, right? But we're sandwiched between the two. We're near the low of the year, which is 152.03, and this is the Dow Jones transports, folks. You do not. It's gonna hold down the Dow. It's gonna hold everything down unless the transports start to move. We're getting this kind of pattern like this, right? So, and this pattern right here is a descending triangle. I didn't draw it in on my chart, but I'll draw it with the pen. So you can see this. The odds favor a break to the downside, and the typical break length is the width of the mouth of this channel, which is right in this area here, which is about 10 points, which would put us down around 42, right in that area right there, which is very near that pivot there. Should it break to the downside? I'm not saying that it will, but that is what that pattern would seem to suggest. If this comes true, then we're going to get that break in the indexes to the downside as well. So it's a very interesting market that we've got right now. Is probably one of the most hated bull markets we've been in for the past couple of years. There's a lot of money on the sidelines, but that's what you get when you get so much currency floating around, low interest rates, no inflation. It's a Fed-induced almost asset bubble kind of rally. I'm not saying we got a bubble now in the assets, but the PE ratios, the forward PE ratios are higher than average. So that's the only thing propping it up. If we had normalized interest rates, the S&P wouldn't be anywhere. I don't believe it'd be anywhere near this, getting the data that we're getting right now. I just don't see it. But this is where we're sitting right now, folks. If you do go in with longs, be quick to take profits, as I tell our members. We're going to be looking at some of the trades I just talked about. We got about 20 stocks that we're looking at. I'm not going through them here. I go through them with our members, but about 20 stocks that look really good on any pullback, should it pull back and start to dip, and then buy opportunities. I think if we get a pullback in the markets of more than 5%, I would say 80% of the stocks, 85% of the stocks will go down, and that'll give us really good buy points on good stocks that you want to get at a lower cost basis. So that's what we're looking at now, everybody. Again, check us out. Like to see you come on in, join us. We got a lot of good things going on. I've also, is in this email that you clicked on to link to this broadcast, There is a link to our trade adjustment webinar. We're coming up on number 9 of a long series. It's worth it. I check it out as well. All right, everybody, have a great weekend, and I will see members. I'll see you tomorrow night. Have a good one. Ciao.